Welcome, and would like to thank everyone for joining us today. The webinar today, Why Companies Are Moving to Captives, Large Deductible, and Other Types of Performance-Based Insurance Plans. Before we begin, a little bit about your technology. Your lines are muted for the duration of the webinar. You can ask questions at any time in the question box. We will be providing answers to those questions at a later date. Those will be submitted by email directly to you. Don't click the black X. It will end your session. Now, about the author. Bob Phelan wrote a terrific book, What You Don't Know About Performance-Based Insurance Can Save Your Company Millions. I've read it several times. It's a very good and simple explanation about the topic today. He has a great background, as you can see on your screen, and he lectures nationally on these types of topics. My name is Alan. I'm going to be reviewing the material today for Bob. So let's start with a quick story. This is a really fascinating story, and if you've been to any of these webinars in the past, you may be familiar with it. But it sort of goes like this. How did they know something 300 years ago that we don't know today? And it begins in 1688 at Lloyd's coffee shop. Lloyd's of London, the coffee shop actually became Lloyd's of London. Ship owners would meet at this coffee shop and discuss their voyages. And of course, as there were ocean storms and problems, they realized they needed a way to share the risk, a very important concept, sort of like the original concept of the corporation, how to raise funds and share in the risk. So what happened is that captains would put their names down to share the risk with other captains' voyages. They would write their name underneath the name of the ship, of the voyage. And that's how we got the term underwriting today. The irony is, back then they knew exactly who they were underwriting. And if they thought Captain John was a bad captain and Captain Bill was a good captain, Captain John would not be getting too many people underwriting, and Captain Bill would get lots of people who wanted to underwrite them. They knew the people that they were underwriting. Today, if you're using traditional insurance, unfortunately, you don't know that. An interesting story. So let's go a few hundred years in the future and talk about today who uses captives, large deductible plans, and other types of performance-based insurance plans. And these are some interesting statistics. So it's estimated that about 50% of all premium in the United States is performance-based insurance. This would be, captives, group captives, and other types of plans, PBI plans. All of the Fortune 500 use some type of self-funding or performance-based insurance plan for their programs. They have the best model. They understood it the earliest. It was highly advantageous and leveraged for them. But we're going to be talking today about how that model is now transcended to middle market companies and how captives are becoming very common today. So who can use captives, group captives, large deductible type plans? Today, lots of companies, lots of organizations. Organizations with total work comp, GL and auto premiums, for example, of $150,000 or more per year are certainly qualified. Perhaps even down to a floor of $125,000 could suffice to leverage this better model. You should have a favorable loss ratio. If you have huge losses and ongoing losses, that could be an issue. But in general, many, if not most companies can take advantage of this better type of plan. And there's many of them. We'll talk about that. You should have, for your organization should have, a commitment to safety or a desire to create a safety-centric culture. That's one of the plan elements, one of the foundations of the plan. So let's go into the basics. And this is going to be a very concise webinar. You're going to pull out everything you need to know in 15 or 20 minutes and go away and hopefully want more information and research how this could be applicable to you. So the basics. What's a traditional subsidy-based insurance plan? What are traditional insurance plans about today? Well, basically, a subsidy-based plan, say you have to pay a certain designated cost. It might be a guaranteed cost, a fixed cost. You pay this amount of premium, $200,000, $500,000, $1 million, and we'll guarantee these types of results for you. You'll only have this type of deductible or exposure. But in doing that, you're actually either subsidizing or being subsidized, which we'll address. So if you're a good company, a safety-centric company, if you have a favorable loss ratio, that means you are subsidizing all kinds of other companies. It's traditional insurance. Captives and group captives apply. Again, this is to a different type of thing. A captive would be for a large company. So a Fortune 500 would have their own captive. A Fortune 1000 would have their own captive. But today, middle market companies, many of them, can join group captives. There's large deductible plans, which we'll talk about, which are similar and very pervasive now, of course, with healthcare. Very common. And all of these are different types of performance-based insurance plans. Literally, there are dozens of these types of plans available. Now, let's start with captives. Well, here's a few examples of captives, and think about these if you've heard any of these names. Risk retention group, self-insured retention plan, participating dividend plan, mini captives, 831Bs, group captives, large deductible plans. These are all captive. These are all types of captive plans. Now, a couple of examples. A group captive might be a group of manufacturers of this similar size, ranging from $150,000 in premiums to $1.5 million in premiums. Safety-centric culture, like-minded, we call that, get together, and they join or they become part of a group captive, and perhaps there's 100 people and 100 companies in that plan, for example. That used to be uncommon. Today is very common. A risk retention group, a group of trucking insurance organizations get together and they share in the risk, and they create this type of risk retention group to share in that risk and reduce their premiums, reduce their costs. There's many more. The 831B basically is there's financial requirements under $1.2 million, and those are more nuanced, and I'd encourage you to call Bob Phelan to discuss that. Who uses it? It used to be the domain of very large organizations, extremely large organizations. It was sophisticated. It was challenging to get into. They would create their own captive. Today, however, as we'll show in an ensuing slide, many middle market companies, many types of middle market companies, all benefit from captives. Why don't all companies use captives? Because some companies are not well run ongoing huge losses. There's sort of a drain on the system, and if you're in traditional insurance and you're a good company, you actually pay for them. They would not be able to join a captive. Now, look at this little factoid at the bottom. Approximately 30 states have passed laws allowing captives to be formed. Vermont, which allowed the first onshore captive, now has about 600. They are becoming mainstream, and companies that are adopting them can be saving hundreds of thousands of dollars or millions of dollars. When you used to hear of captives, you always thought of the Cayman Islands. Today, many of these are now onshore U.S.-based captive and group captive plans. So we also mentioned large deductible plans. Now, that's probably a much simpler concept for everyone. Everyone understands what a large deductible plan is. It's becoming very common in healthcare, though today, of course, we're talking about the other side of things with workers' comp and auto and GL, et cetera. But basically, you're adopting more of the risk because you have a greater insight in knowing your claims history, and you say, every year I'm paying huge amounts of money into the insurance company, and our claims are negligible. They're running 10 or 20 or 30%. Basically we're just pouring money into the insurance company and losing money every year. However, what would happen if you had a catastrophic claim? Well, with a large deductible plan, it can be arranged that you have a buffer layer, that you are transferring that risk, which is very important insurance concept. You're transferring some of your risk to another organization. And that catastrophic risk, you're covered in the event of an unlikely and an unacceptable claim. However, smaller risks are covered by your organization. The normal claims, the everyday claims, and that might be up to your comfort, your level of comfort, that threshold. So, for example, You might say we're going to cover all claims up to $10,000 or $25,000 or $50,000 for a larger organization, even more. But again, you are insured for the catastrophic risks. Now, what are the typical challenges found with traditional insurance companies? Let's just review that before we go over performance-based benefits. Let's look at the challenges. You probably, many of the companies on the call today probably have encountered these. All of a sudden you have an unsubstantiated rate increase. No, just out of the blue, no particular reason, hard market, soft market, you're not quite sure, but all of a sudden, bam, you're hit with a large rate increase, which may be exogenous in nature, caused by circumstances or companies outside your sphere of influence. All of a sudden, there were some companies that had huge claims impacting you in your pool. Of course, you don't know who's in that pool, and you get hit with a very large increase. You have a lack of information, of insight. We're talking about this pool, and we said 300 years ago at Lloyd's Coffee House, they knew who they were underwriting. Today, you have no idea who's in your pool. There's a lack of flexibility often for the plans. You don't get to customize it very much. There's no reward per se for favorable claims. Yes, you might get a little discount, but if you are running really low loss ratios, you have great loss ratios for 10 years, very little of that is returned to you. Now, this boldface bullet is very, very important. Conceptually, I want everyone on the webinar today to think about this. If you're a well-run company, if you're driving a safety-centric culture, you are subsidizing all the companies with poor claims history. In actuality, the safety programs that you might be doing are benefiting the carrier, not you. Now, performance-based insurance. Well, the converse of the prior slide is true. There's greater flexibility over plan design. You have much greater control over what that plan looks like. You will understand your claims experience will directly benefit you and the companies in your pool, by the way. Also, you will know their claims experience. So like Lloyd's Coffee House, you'll know the companies that you're sharing risk with. This is somewhat dependent on the type of performance-based plan that you go with, but let's use this as a common thought for the moment. Keep the profits, the inverse of the prior slide. Instead of the profits going to subsidize other people, the profits are returned to you. These are often in the form of dividends, but there are many ways that can be done. And you're rewarded for your favorable claims history. So let's look at this in graphical form. If you could all make sure you're looking at your screen right now, you'll see two pie charts. And this sort of oversimplifies it, yet clarifies it, because this is the basic concept. We have traditional insurance plans on the left and performance-based insurance plans on the right. Note the 70% of the slice. The 30% doesn't change. The 70% changes dramatically. 30% is essentially used to run the insurance company. This is going to be true for a group captive as it's true for an insurance company. Ballpark. I could argue that the insurance companies are even higher. However, the 70%, instead of representing subsidizing others, going to the profitability of the insurance company, going to the shareholders of a public insurance company, for example, the 70% are returned to you. Very, very important conceptually. So let's talk for a minute about the carrier's cut, that 30 or 35% perhaps in the form of a carrier. Let's talk about that for a minute. So carriers have high expenses, but in a way, you have to wonder if they're really incentivized not to have high expenses. They have profit margins and shareholders to satisfy. But in a way, it's almost like dealing with a bookie, with a betting pool. So basically, as long as they can cover the costs of the claims, that 70% goes to cover the cost of the claims. They take the rest of the 30%, and that goes towards advertising. It could go to shareholder returns. It can go to executive compensation, stock options, perks. It goes to a lot of places that you wouldn't want it to go. They, in a way, want to perpetuate the norm. They would not want their good companies going to group captives or captives. because the good companies are what's helping them subsidize the bad companies. Interesting concept. So this can be simplified even further into this triangle, and I really like this chart. And it talks about the relationship between safety, injury management, and performance-based insurance. If you have a strong safety program and a strong injury management program, you will reap the benefits in a performance-based plan as opposed to the carrier reaping the benefits in a traditional or subsidized plan. Very important conceptually. So let's talk about the financial benefits of PBI, performance-based plans. And sometimes these are unrealistic. As a matter of fact, not long ago I read a study that says that as the commitment to lower premiums goes up, the believability of prospective clients goes down. They don't believe the number. So and there's elasticity there. So if we say we can reduce premiums 9%, it's much greater believability than we can reduce premiums 25%. Interesting. However, pragmatically, performance-based plans will often reduce costs 25 to 35%. We have a few examples in a moment. That I realize that's a huge number. Huge number. If you're paying $500,000 in insurance, that's $150,000 a year, $1.5 million over a decade. For clients $1 million in insurance or more, it becomes very significant. $300,000 per year for that type of claim. Sounds too good to be true, but in actuality it isn't. It's a cultural change. It's a thought process change. It's a change in the way in which you've been probably doing business for a long time. But let's learn from the Fortune 500. What are they doing? Why are they doing it? Why are they benefiting from it? And can that be then transcended to middle market companies? And the answer is yes. Now, this is a radical thought at the bottom, the third bullet, the last bullet. Some companies, those companies with a comprehensive safety program, can, and will literally reduce their ongoing insurance costs by 50%. And this is a time-centric, so the longer you go with a performance-based plan, the more likely it is that you will see that type of savings. It is predicated upon the type of company. It is predicated upon your injury management program, and we are going to talk about that in a moment. So look at this graph, this chart. Fully insured traditional programs, performance-based insurance programs. Fully insured on the left, performance-based on the right. We've talked about this already a little bit, but key things. Premium is determined by you, not the carrier or exogenous market forces. You control premium swings. In fact, you can really flatten out your premium dramatically. You could have a similar premium for a decade. You earn the financial rewards, and very important note, plus tax-deferred underwriting income. We can't go into that today, but again, if you call Bob Phelan, he'd be glad to review that with you. And this is a very important one, the last one. You never go out to bid, which is sort of almost oxymoronic. You never go out to bid. So all that time reviewing bids, trying to keep the brokers, and the carriers honest, you never go out to bid because you're controlling the process. Interesting. So what about safety-driven cultures, and how does this interact with performance-based insurance? Why have we mentioned this multiple times? And in the next slide, or the slide after, we're going to actually talk about a nursing home and how a safety-driven program dramatically impacted them. So the safety-driven culture rewards both employees and owners. Healthier, happier, better absence management, employees, better absence management programs benefits the employees, it benefits the owners. It controls surprises and has a very large impact on profits, not just from the insurance we mentioned, but also from the continuity, from absence management, from many different perspectives. So one of the things that we do for organizations is we look holistically at what's happening, not just how's this impacting your insurance, but also with safety, what can we do to improve the culture and get a control on injury management? So take a look at this. 3 really interesting examples. We have all these types of organizations on the phone today. So the first one, and I had mentioned injury management, so the first one is a nursing home chain. So this is a client, nursing home chain, spending large amounts of premium every year, was in a traditional program. By bringing in a consultant to help them get a control on injury management, specifically the physical moving of patients, which, as you can all imagine, can cause all types of injuries, including back injuries. By bringing that consultant in, we reduced premiums $1 million per year. So not only do we have happier, healthier employees there, but a dramatic improvement to the bottom line. A regional contractor, to give you an idea of size, this one's $100 million in revenue, and this is a big and perhaps unbelievable number, reduced their costs over 50%. So that gets back to the example. There's an actual example, regional contractor, Connecticut area, $100 million in revenue, reduced costs over 50%. And a petroleum distributor is earning 35%. That gets into that dividend. So essentially 35% cost reduction. They get 35% back each year that they've been participating in the plan. So to talk about that a little further, how can you determine if you could be one of those 3 companies or 3,000 companies? So the first thing you say, do you spend at least $150,000 on workers' comp, on general liability, on auto? And if the answer is yes, then you ask the next question, which is, are you putting in a program today that do you have a good safety culture? Are you willing to put in a good safety program? Are you willing to invest in that type of cultural change? And if you've had a favorable loss ratio, you are an exact candidate for this type of program, and it's a shame for your premium dollars to be benefiting others, including potentially your competitors. So to find out if you could qualify for a performance-based plan, 15 minutes is all it takes. Call Bob Phelan. His phone number is below, 860-761-7201. He's the author of the book. He is an expert in this area. If you would like a complimentary copy of the book, drop us an email, respond to your invitation, or drop a call. We'll be glad to get that to you. It's a very quick read, a very fun and interesting book, and it talks about a safety-centric company versus a non-safety-centric company and the results of performance-based insurance. It's a really interesting vignette. We very much appreciate so many organizations taking the time to attend this webinar today, and we appreciate your interest in performance-based insurance and hope we've covered the basics appropriately in this 25-minute webinar. With that, this webinar is now ending, and we hope you all have a great day. Thanks again.